Good morning. Thank you very much for returning after tea. So I'm going to be talking about what is a token, and I have brought with me my co-authors on this project, Chris Berg and Jason Potts. Please feel free to ask them all the tough questions during the break, and I will be doing the presentation. So just a bit about ourselves. We're from the RMIT Blockchain Innovation Hub. This is an initiative of our university which has started up in the last couple of months. And what it is that we are doing is creating short courses, long courses. We're looking at research into the blockchain. We're creating an observatory, and we're also dealing with policy and applications. So basically, everything related to the blockchain that we can think of is what we have promised our administrators we're going to be getting up to. Now, the take-home message, more or less, from a paper with Potts and Primavera de Filippo and myself, we say the blockchain is a platform for building bespoke economic coordination. That's actually what's going on here, not solving cute and difficult and complex problems or dealing with incentive issues, what have you. What we're actually saying, the blockchain is going to be about economic coordination that involves programmable money and programmable organizations and contracts. So what we're doing today is just focusing on what it means to have programmable money. And more or less our argument is that tokens, or coin as you prefer to call them, are not money. Everybody thinks of them as money. They were designed as money. In actual fact, they are not money. They are a financial instrument which can be used to finance asset-specific organizations. Now, in the current financial system, equity can do this, but not debt. But on the other hand, tokens are rules-based financial instruments like debt. So our argument is that tokens, not being money, are some sort of hybrid between debt and equity. That's the take-home message. Now, we've been talking about, amongst ourselves, something called institutional cryptoeconomics, and starting off by asking some basic questions. What is the technology that is the blockchain? Now, it could be a production technology, the sorts of things economists normally think about. So neoclassical costs, it brings those down, that's fine. It could be an exchange technology that's all about transaction costs, which is what some economists have spoken about. We actually make the argument that it's an institutional technology. This is about lowering information costs and driving value through that. Now, the nice way, or the nice thing about that is that there is a large economic literature on this topic already, involving at least 2 Nobel Prize winners, Ronald Coase in 1990 for his work in his 1937 papers and 1960 papers, and Oliver Williamson, the 2009 laureate, which very nicely is an emeritus professor here at Berkeley. So we thought we would actually promote his ideas while we are actually at the university. Now, his story was about alternative governance structures of organizing economic behavior and transactions. They have all got different costs and benefits associated with them, and we should be thinking about those costs and benefits in terms of firms and hierarchies. So, transaction cost economics poses the problem of economic organization as a problem of contracting. So we hear about smart contracts. We've spoken about them today already. So we start off with the notion that there's a particular task that needs to be accomplished, and this task can be accomplished in various alternative ways. We can have markets, we can have hierarchies. Under hierarchy, we can have government, or we can have firms. Those firms can be for-profit, non-profit, so on and so forth. There's a great deal of hierarchy around, and we're all kind of familiar with it. Now, before 2009, if we wanted to get something done, we would either make use of a hierarchy or we'd make use of markets. After 2009, we can actually make use of hierarchies or markets or the blockchain. And as a matter of fact, the blockchain erodes a lot of the advantages of government. It erodes a lot of the advantages of firms. It actually drives market incentives deeper into government organizations, deeper into firms, and that is actually where the value is going to be created. So now, what can we say about contracts? So this is a very famous work by Oliver Williamson, his 1985 book, The Economic Institutions of Capitalism, all about contracts. And there are 4 kinds of contracts that we can have. The first one is planning. So we all sit down and we work out everything that could ever happen to our contract, and we come up with a plan to deal with those contingencies. That's, of course, very expensive. Or we have promise. I won't let you down. Don't worry. We have a contract. If anything goes wrong, I will look after you. That's promise. Or we have what Williamson calls competition, but is actually spot market economics, or what we sometimes call milk bar economics. Now, you walk into the milk bar, which I think here in America would be a 7-Eleven, something like that. You walk into the milk bar, you pick up the item that you want, you give the person behind the counter your money, and you walk away. This is a very sharp contract because you have the item, they have the money, everybody's happy. That's the kind of situation that most economists think the entire economy operates around. Easy to observe transactions. But in actual fact, we have governance. So we don't have easy to observe performance, we don't have easy to observe transactions, and so we need to have some sort of governance structure. Most of the economy filters around competition and governance. Our argument is that the blockchain is actually going to take us into a world of promise. So how do we differentiate between planning, promise, competition, and governance? And there are some differentiating factors. The first one being some behavioral assumptions about people, and second one, the kind of assets that we invest into, asset specificity. So those are the three things. Going through them, bounded rationality is something that Williamson has been quite big on. He got the idea from Herbert Simon, also a Nobel Prize winner. And this is the idea that the human mind is itself an economic resource that needs to be economized on. So we make use of heuristics, we jump to conclusions, we don't make full use of the information set. Now, I think this is all true, but I'm not actually convinced that this is a good argument to have. So what we want to do is replace the bounded rationality assumption with a radical uncertainty assumption, which will allow us to bring in all the work of the Austrian school. So Mises, Hayek, Rothbard, Kirzner, all those guys, all their insight comes in to this approach if we substitute radical uncertainty for bounded rationality, and our view is that bounded rationality is simply a subset of radical uncertainty. But the big assumption here is opportunism. Now, economists, generally speaking, we get defined as the dismal science because we have a poor view of humanity and all that sort of stuff, because we make an assumption around self-interest. Now, opportunism is actually more than self-interest. We don't just look after ourselves. We lie, we steal, we cheat, we obfuscate. After all, we are making money here. So human beings are actually, or can be, quite bad animals in the grand scheme of things. So there's a very strong assumption made around how we will behave when things go wrong, when money is involved. Then the other assumption is asset specificity. Now, standard economics makes some very strong homogeneity assumptions. All assets are the same. All capital is the same. All labor is the same. Where in actual fact, those homogeneity assumptions are very easily violated in reality. So in most business situations, we have a contract between the two of us, and in actual fact, what I have to do is make a specialized investment. I have to build a particular machine, I have to have a particular plant, I have to have a specific app in order to make our relationship work. That's called asset specificity. So I could have to do it in a specific place, or specific skills, or some dedicated asset. The asset specificity assumption means that we can't simply have a spot market transaction. So a lot of organization that we observe in the world is designed to actually make sure that people don't behave badly, that's opportunism, when we have asset specificity. Yeah, so that's some background. So let's add up our behavioral assumptions and put that into our contracting process. If we have no radical uncertainty, but we do have opportunism and asset specificity, we can plan. Of course, we all know Professor Hayek said we shouldn't plan too much, and we all know that Michael Oakeshott said Professor Hayek has a plan not to plan, and that's one plan too many. So planning is, generally speaking, not going to be working too well in most situations because of either bounded rationality or radical uncertainty. But if we live in a world where there's no opportunism, there's promise. I can have ex post settling up. I can say, guys, let's go into a contract, let's have a business, and if things go badly, we will compensate you. I don't know how I will compensate you, but I will. Okay? That is not a credible promise right now. Then if we have a world where there's no asset specificity, the kind of world that most economists imagine, we're living in a world of competition. And when we have a world of bounded rationality, opportunism, asset specificity, all three of them, we live in a world of hierarchy and governance. Our argument is that the blockchain limits opportunism. We can actually write smart contracts that will settle up after the fact. We can make far more credible promises than we can at the moment. So what happens is we believe that the blockchain will move us from a world of competition and governance into a world of promise. Now, this is quite important because a competitive world, or world of spot markets, can be very expensive. There's the well-known market for lemons problems. There are a whole bunch of economic transactions that just never take place. The world of governance is also expensive. We have the agency problem, which we all understand business executives run away with the shareholders' money. That is an agency problem. That is a huge problem. But we also have something called the promoters problem, where entrepreneurs or people, startups, people going to the market to raise money, knowingly sell bad securities. The blockchain does not resolve that problem. It can resolve the agency problem, and it can cause a lot more transactions to take place than otherwise would have. It doesn't resolve the promoters problem. So the governance problem we understand, people running away with the shareholders' money, stealing from the company, so on and so forth. Again, what's very nice, there's a large literature that deals with this. The agency theory literature, Jensen, Meckling, Farmer, and Jensen, what have you. Farmer is also a Nobel Prize winner. And then Williamson. Williamson in 1988 wrote this very speculative paper about applying his transaction cost theory to finance. And what did he say? He said, well, debt and equity are not financial instruments. It's not a case of they've got different promises around cash flows. They actually have different governance mechanisms. And he made the specific argument that debt is rules-based. You can borrow money under these circumstances. You have to pay it back under very specific circumstances. If you violate certain conditions, you have to pay it back automatically and so on. He said debt is a very market-based, rules-based financial instrument. But the downside of debt is that it doesn't finance specific assets. If you have specific assets in your organization, you have to finance them using equity. Equity is a discretionary-based financial instrument. It is a hierarchical instrument, and it will finance specific assets, but at a cost. Now, this reminds certain economists of the argument for rules over discretion. Generally speaking, economists would say it's better to have rules rather than discretion, and Williamson asks the question, why is it that we can never promise to do the right thing? Why does rules dominate discretion and not discretion dominate rules? And he creates a fictitious financial instrument that he calls dequity. And he said dequity would work like debt when it needed to work like debt and work like equity when it needed to work like equity. But dequity could never, ever exist because of opportunism. Our argument is the blockchain suppresses opportunism, doesn't eliminate it entirely, suppresses opportunism over a whole range of financial transactions, and therefore tokens are dequity. That's a terrible, terrible name, dequity. It just doesn't roll off the tongue. Okay, but nonetheless, tokens are this theoretical financial instrument which Williamson spoke about in his 1998 paper. And when you can control opportunism, you can have a financial instrument like dequity, which we now call tokens or cryptocurrency, actually being economically viable. So there we are, a rules-based system that can finance asset-specific investments in organizations. So it acts like equity when it needs to be, it acts like debt when it needs to be. But very clearly, tokens or cryptocurrency are not money as we understand them. Now, what have we got? The insights. They are not debt because they can finance specific assets, not equity because they are rules-based. Very importantly, tokens are not money. Money is a discretion-based instrument issued more or less by governments. That's what it is today. This is very consistent with Satoshi Nakamoto's vision for Bitcoin. He said he wanted to have a rules-based money. Well, here we got a rules-based financial instrument that can't be money. It's actually investment. Bitcoin and a lot of cryptocurrencies are simply too valuable to use in day-to-day transactions. You would use them to buy yachts. You would use them to rebalance your portfolio. You are not buying your bread and milk and eggs and pizza with a Bitcoin, certainly not today. Now, this insight does not play into the traditional arguments where money is a medium of exchange, a store of value, a unit of account. Anything can be those things, and cryptocurrencies could be those things too, but our argument is they are so much more. Which makes them very valuable. What else can we say? So they're a financial instrument and should be treated like financial instruments. They should be regulated and taxed accordingly. I suspect a lot of people don't want to think about regulation and tax too much, but we've got good arguments why you should be thinking about those things. Investors should think of tokens as an asset class. So if you've got a well-diversified portfolio, you're going to have some stocks, some bonds, some cryptocurrency, some property, so on and so forth. It should be thought of in that same way. ICOs should be thought of as more or less as IPOs and should be regulated by the authorities as best you can along the IPO lines, bearing in mind we still have the promoters problem. There are going to be a whole bunch of coins coming to the market that are not actually worth very much. When those coins go broke, when people lose money, financial regulation at that point will become a safe haven. Because the good promoters, the people who are genuinely trying to raise money in order to finance new activities, bring new products to market, don't want to be caught up with the bad ones. So you need to still have a mechanism of sorting good from the bad, and regulation is a way of doing that. So you want to have good regulation, which of course we all want to have good regulation. We seldom ever have it, but that just means that the industry is going to have to be like every other industry and have people talking to government about what is good or bad. But certainly a costly signaling model, so you want to be issuing your coins in places like Singapore, perhaps Hong Kong, places like Australia, these sorts of places where you've got a good regulatory environment, you've got more or less good regulators who are trying to at least promote industry. So rule of law, strict but a friendly business environment is a costly signaling model, and that will differentiate the good promoters from the bad promoters. And of course, the great irony is I'm not immune to the fact that regulators themselves will be disrupted along with many of the industries that they are regulating. But I don't think you can get away from it. Arguing for a zero regulation policy approach is probably not going to be a good idea. So thank you very much. This is who we are. Please look us up on the internet and follow us on Twitter.
Thank you, Sinclair. Any questions?
Can you go back to that slide with the asset specificity and the role-based?
Talking? Oh, that's random. All right. Good day, good day. Could you just go back and kind of re-clarify what you was referencing when you was talking about the debt and specific assets? I mean, I don't know about everybody else, but that kind of went over my head. So just could you clarify what you mean when you talk about debt not being able to do specific assets, equity for specific assets, and then when you flipped and said that tokens do the opposite? I totally missed what you were trying to convey in that point.
Yes. A nice way of thinking about it is specific assets are very risky. And you don't want to be financing a very risky asset with a very riskless or less risky financial instrument. So if your specific asset, which is very risky, suddenly loses money, you want to impose that cost on the equity holders, because the equity holders are people bearing that sort of risk. So you can simply say, look, guys, we're really sorry. We didn't make any money this year. Our specific assets didn't work, and therefore you're not going to get dividend, or you're not going to get a capital gain. You can't do that to your debt holders. They have to get their coupon payments every quarter or every 6 months or however long your coupon instrument is. They have to get a coupon. So you want to use debt to finance steady cash flow assets, and you want to use equity to finance risky cash flow equity assets. And specific assets are more risky. So it is simply a case of you want to match the assets that you're financing with the financial instruments.
Any other questions?
Any other question?
Okay, thank you so much.
Thank you very much.